What is happening, everyone? Hope you're having a fantastic day. Just wanted to hop on here and talk about employment in regards to getting a mortgage loan. Get a lot of questions. Have clients that reach out and say, hey, I can't be on the loan because I haven't been on my job for 2 years. So I wanted to address that statement in and of itself, because there's this misnomer that you have to be on your present job for a minimum of 2 years in order for you to get a mortgage loan. And that is just not the case at all. Where you're getting that mixed up is you need a 2-year history. What that means is you have to have a consecutive 2-year history with no major gaps, and major gaps basically being anything over about a month's time. It does take a little bit of time for some people to transition from job to job, but most loan programs look at a gap of being greater than 6 months. So you definitely want to not have any major gaps and have a 2-year work history. Now, I'm not going to get into the specifics. Some loan programs don't want you to have more than 3 jobs in the last 12 months. It doesn't really matter as long as you've got the 12-month history specifically. But I wanted to address that because I've had literally clients think that they cannot get qualified for a mortgage because they haven't been on the same job for 2 years. Now, however, let me talk about that. The 4 C's of lending, and the 1 C of capacity, which is your ability to pay the loan back. So lenders are looking for stability in your employment. So when you are applying for a loan, they want to see, have you maintained a job? Have you at least stayed level playing field? Have you moved from job to job? In other words, if you're making $15 an hour at this company and you move to this company, maybe you won't make more money initially, but maybe the upside is much greater for management or some other opportunity that maybe you are making either a lateral move or you're improving yourself. Where things come into question, it doesn't automatically mean a turn down as if you are decreasing. So in other words, you go from one position and now you move to another company and you're making less money. I've had people do that because they wanted to be closer to home, because they were driving 45 minutes to their job, where the new job may pay $1 less per hour, but they are 3 minutes from the house. But again, there's upside potential there. So guys, you definitely want to get with your mortgage lender, your mortgage advisor, and talk about your employment history. So that way they can assess and make sure that you're good. You never want to disqualify yourself by thinking that you need a 2-year work history when in essence do not. So keep that in mind, making sure that you've got a 2-year history, and we can get into the specifics with you when you talk to us about that, where I'll literally have somebody lay out their last 2-year history. They went from this company to this company. These were their positions. This is the reason why they did so. Obviously, from our perspective, it does make it much easier when somebody applies for a loan and they've been on their job for 2 years, 3 years, 5 years, because we only have to verify one employment history. Whereas if somebody has multiple jobs, we do have to verify those multiple jobs and make sure that what you say, your W-2s and your tax returns and all those things actually match up with the income that you're reporting to the IRS, as well as the jobs being aligned with those dates and that income. And so it makes our jobs a little bit more difficult, but in essence, it will not disqualify you from a loan specifically. We just need a 2-year work history. We need a 2-year rental history or a residency history as well. So again, you don't have to be at the same residence. I've had people that live in 6 different places in the last 2 years. Again, we just have to build that history, put that puzzle piece together for the underwriter, for the investor, to make sure that it's solid, that we have that consistency, because those 2 years matter. Again, it doesn't matter what's in those 2 years per se, as long as it makes sense ultimately. And then I also want to talk a little bit about income, because this comes up as well when we're talking about W-2 employees. A client will come to me and say, hey, I make $15 an hour and I work 40 hours a week. Now, when I pre-approve folks, I actually ask for a pay stub and a W-2, couple W-2s, last 2 years W-2s, tax returns, whatever is available, so that I can look at and see the income and make it make sense. Because somebody may tell me they make $15 an hour or 40 hours a week, but if their year to date does not mesh with that narrative, then there's going to be questions. So I get clients that get frustrated a lot because they go, no, I do work 40 hours a week. But in essence, what happens is when we actually look at the pay stub and we look at the year to date, if that year to date doesn't mesh with $15 an hour times 40 hours, there could be a couple things that potentially happened from the beginning of the year. Maybe you got a pay raise. Maybe you missed a chunk of work because you were out for health issues, or maybe the place you work shut down for a month. there's typically an explanation for it. But if there is no explanation, then it's automatically going to be looked at as variable income, that you actually weren't working the 40 hours a week. And therefore, that we have to mitigate or look at that income a little bit differently. That's why it's so vitally important when you get pre-approved that you make sure that whoever is the advisor, mortgage advisor looking at that they're asking for pay stubs and W-2s. I've seen more deals get absolutely denied because the income wasn't verified. It was basically just over the phone. I make this much per hour, this much per week. This is how many hours I work. And then when a pay stub came over, it was way short year to date. The W-2s were way short and there wasn't a good explanation for it. It was, well, I only averaged 30 hours a week or whatever the case may be. When that doesn't matter if you've been there 5 months or a year, 2 years, 3 years, again, there's not necessarily a cookie cutter way of looking at it. That's why it's important that an advisor looks at your pay stubs, looks at your W-2s, and identifies and makes sure that you're making the income and that everything makes sense, because they're always going to look at the most conservative approach for income. They don't want to stretch it. They don't want to put you into a situation where you're going to be house poor. So they're going to look at the most conservative approach for income, especially when they're looking at bonuses and overtime. They're going to be using those types of averages. It doesn't matter what you think you're going to do in the future. It's what you've done in the past and basically looking at those averages so that we can give you the most conservative approach. There are ways to get a little bit more aggressive with income, but you have to be able to put the data together for it to make sense for the underwriter. Otherwise, it's always going to default to the conservative. And again, I know this frustrates a lot of folks. I've talked to clients that think that they're getting shortchanged on their income, but at the end of the day, the investors, the mortgage companies, industry as a whole never wants to put you into a situation where where it looks like on paper you're not making as much money. You're potentially going to make more money, so we're going to give you that advantage. And then all of a sudden, your debt ratio is way out of whack, and you're in a house you shouldn't be paying for, and that's potential risk. So at the end of the day, guys, always want to make sure that when you're talking to your advisor, that they're asking for pay stubs, that they're asking for W-2s. I've gone to the point where somebody's had so many positions, so many jobs in the last 2 years that before I even issue a pre-approval, I went and got verifications of employment before I issued a pre-approval, making sure that these dates and things line up. Because again, 26 years in the business, I've seen deals absolutely collapse because myself or other lenders have taken the word of the client. Again, it's not an intentionality. The client's not necessarily lying, whatever. At the end of the day, the client's just recollecting off their memory. I worked at this place from this date to this date. And then when we actually go get the dates from the employer, the dates are a little bit off, or it's been off enough to where there's been a gap, and then that can be a problem. So guys, just make sure that when you're getting with your advisor that you're laying all of this out for them so that they have a great painted picture for the underwriter. Because again, I like to say that the mortgage industry and the way we do things is like putting a puzzle together, and we're literally putting those puzzle pieces together to make this beautiful picture to the underwriter that's never met you, never meet you, as to why this loan should happen based on the credit and the capacity and the collateral and the capital of the whole picture of the loan for it to make total sense to do the loan. And so that's why all those pieces need to be in place. So I hope it's been helpful to you, talking a little bit about employment history. You don't have to have 2 years on the same job. You just have to have a 2-year history, consecutive, with no gaps, and income-wise, why we look at kind of things from a year-to-date perspective. Get a lot of questions about that. So thought I'd do a video. Hope that's been helpful to you. Until next time, bye for now.